Hello investors. In last month, we have witnessed materialization of our long-held view on shifting economic policy priorities in India, from controlling inflation to supporting growth. This came in form of rate cuts in MPC and tax cuts in the union budget. Now, what is panning out looks like a more coordinated policy response where all the levers available to the policymakers are put to action to support growth, right from fiscal, monetary, liquidity, and even easing of macroprudential norms. For years, however, tight liquidity, profit booking, and tariff-related announcements led to a situation where GSEC yields went up slightly even after the rate cut. A few obstacles which were creating complexity in choices available to the policymakers and even in transmission of rate cuts in economy still remains, but there are some improving trends. Firstly, we see proactive approach in liquidity management by RBI. Second, welcome reversal in the lopsided long dollar views in FX markets. Globally, inflation continues to move towards the central bank targets in all major economies, but the speed of the progress has slowed and in some cases has even reversed a bit in recent times. This is mainly because of goods inflation this time. In US, inflation readings are still strong, providing further evidence that achieving the last mile disinflation will be challenging. Other central banks gradually continue to reduce their policy rates, like Bank of Canada, which leads with the 200 bips of cut since mid of 2024, and the European Central Bank, which has cut 125 basis points in this cycle. While the US Fed Reserve still holds the rate steady after the last rate cut, which was done in December 2024. Domestically, in India, economic growth rate is normalizing towards its medium-term trend. It is driven by a balanced set of domestic drivers. However, the ongoing geopolitical and trade-related uncertainties pose some downside risk. On the other hand, fiscal 2026 will be supported by the factors such as lower food inflation and lower borrowing cost. Going ahead, we can expect FPIs to take more nuanced view of emerging market currencies, and now as we see heterogeneous movement in other currency pairs. We still maintain our call of a 50 basis point rate cuts in this cycle as there are too many moving parts increasing the global economic policy uncertainty. There can be scenarios where the possibility of deeper rate cut cycle can evolve, but high frequency data till now does not indicate such stress and growth as yet. For rates, however, this macroeconomic setup means higher G spreads than seen in past as investors need to build some margin of safety, especially when coming out of Goldilocks scenario, which we have been in past. We believe the government securities market will still remain well-bid as the expectation of few future rate cuts sets in, and a well-balanced demand-supply of government securities act as a mitigating factor. This can generate capital gains. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.